Good morning and welcome to Foundation Friday. We have a special guest, Adam Braddock, today, who's going to be teaching us how to use your real estate license to invest in real estate. All right. Take it away, Adam.
All right. Hey, you guys. This presentation was admittedly somewhat slapped together. I will probably take some tangents and please feel free to pop in with a question anytime. Jason or Joe, if you see somebody like raise a hand on Zoom or something, if I miss that, just stop me in my tracks and we'll tackle it. But this is essentially I don't have any special skills or knowledge necessarily that any of you couldn't possess. So essentially, I want to share my personal journey with you and how I got into real estate investing using my license, and just show you that my sort of accidental journey could be something anybody can do. And it definitely takes time, sometimes a lot of patience and stuff like that. We'll talk about that. But anyways, I'll start sharing my story here. First of all, just quick intro. I became a realtor in 2016. Prior to that, I was a nurse at Children's Hospital in the ICU and at Providence in the emergency department. I also spent 2 years I spent 10 years nursing. I spent 2 years as a PCV in Kyrgyzstan. I don't know if anybody knows where that is. It's in Central Asia, and a PCV stands for Peace Corps volunteer. My hometown's Bellingham. I've lived in Everett, Seattle, and Mukilteo throughout my years. And my real estate portfolio looks like this right now. We have one Airbnb in Seattle. We have a single family home in Everett. We have 4 townhomes in Burlington, and we have 2 duplexes in Cedar Woolley. That's 4 units. And we have 4 vacant parcels, kind of unimproved land right now in Burlington. And when I talk about these things, I definitely want to point out that this is only my journey. There are so many other paths into real estate and real estate investing. So keep that in mind. And this is just the stuff that I know so far. And I am learning so much more all the time. Consider myself still quite a newbie investor. So some of the benefits of real estate investing, obviously, to me, number one is appreciation. Number two, I don't know why that's green, but hopefully you guys can see that. Number two is appreciation compounded by leverage is an incredible tool that can exponentially increase your net worth over time. By leverage, I mean just, if you're putting 20% down on a property or 25 or 30% sometimes in real estate investing, then a lender or bank is putting another 70 to 80% of that down. So for every dollar you put in, obviously, then maybe $4 is matched by a lender, especially in a primary residence, sometimes even more than that. And then that leverage means your appreciation you get appreciation on every dollar, not just the one you put in. So that's been kind of a huge realization for me that I kind of stumbled into. I'll talk about that a little more. Obviously, tax deductions. And if you're not aware of this, I'm sorry if I'm already like repeating stuff you guys are aware of, but the tax code has a lot of additional deductions that real estate professionals can take in real estate investing. Probably the most valuable one is bonus depreciation or cost segregation. We can talk about that a little bit. Number 4, amortization. That is when somebody pays, you got a tenant renting a property and they're paying your principal and interest. A lot of times they're paying 80-90% interest that they're paying for your mortgage, and 10% maybe on the principal, and over 30 years that gets paid down completely. And then cash flow. A lot of people talk about cash flow. Personally, for us, in our experience, it hasn't been the goal. Cash flow, I think some people equate cash flow to financial freedom because you can take in passive income, and kind of relax maybe on your job, or you can quit a full-time gig and try other things because you have that cash flow and freedom to do that. I think around here, for one thing, it's kind of tough to find cash flow properties to invest in. You can definitely find cash flowing properties in areas like Ohio and Georgia, Texas. Around here, it's challenging, but if you're patient, they will cash flow eventually. So, and then for my personal journey started here in 2006. We bought our first house. This is it. We paid $275,000 for it in December of 2006, and that was right before the bubble burst. I remember renting a house, thinking and seeing prices of homes going up everywhere. It was crazy. 2005, 2006. And I just thought, we got to get on this roller coaster. We got to jump in there and buy something. We bought basically one of the cheapest houses that was available in Everett, and it was this house. And soon after that, I kind of enjoyed the ride. We would check Zillow and Redfin to see what our home property estimate was for about 4 or 5 months. And we were like, yay, we're up like $15,000 or $20,000. And then it took a steep dive, as everybody knows. By 2012, this house was worth $185,000. We were way in the hole on it, $90,000 to $100,000. We had a toddler and a newborn, and we were ready to upgrade to a larger home. Fortunately, at that time in 2012, we were able to find a house on Mukilteo Boulevard, a nice house, 3-car garage for 2,500 square feet for $335,000. That still kind of blows me away that we found a house that cheap. However, we couldn't sell this house because we were underwater. If you're not familiar with that expression, it just means we owed a lot more on it than we could sell it for. And that created that short sale environment that a lot of you probably heard of. And that's how we got our house for that second house. That second house that we bought for $335,000. The previous owner of that house had paid $580,000 for it in 2006 as well. So kind of at that peak. At any point, should I take questions or anything? Are we good?
No, you go ahead. It's your journey, and I know there's some thought like, oh well, maybe I'm gonna repeat stuff or people already know this, but this is a great story. We love to hear just how things went for you, and
Okay.
so far so good. You're knocking it out of the park.
Okay, thanks. So anyways, we had this house, owed a ton of money on it. We were able to get into another house. This title of this slide, obviously, working through negative cash flow and personal setback. So our mortgage on that house at the time was $1,600, and we could only rent it for $1,200. So we ate $400 a month on that little house. We thought about short selling it, but we also heard that's going to really mess up our credit for about 7 years. And so we thought, let's just try it. I can work an extra shift at the hospital. We could squeeze out an extra $400 a month and cover that loss. So unfortunately, at that same time, and not due to financial stress, my wife and I separated almost immediately after we bought that second house. So that began sort of my managing property journey. I was living in an apartment soon after that and managing the little rental house, and we were both paying that loss together. And then it worked out eventually over time, being patient. I think after about a year, we were able to rent the house because a lot of people were selling their homes at the time, short sales and stuff like that. Rent prices started to go up. And so within probably 2 or 3 years, our rent was starting to cover the mortgage. And when in 2013, I realized after we did our taxes that actually what I thought was a loss on paper, we were actually breaking even if you started to think about it. After meeting with our accountant, there was depreciation on 275,000 over 27 and a half years. That's how you kind of calculate depreciation, was $10,000 a month. Isn't that a convenient number? Or $10,000 a year. And if you paid 15% in the 15% tax bracket, which I was at the time, that was $1,500. So that offsets about 3 months. We also had property taxes. We had mortgage interest, which was huge. We had maintenance and utilities and insurance. So all that stuff added up to actually be breaking even on what I considered, or what we felt like was a loss at the time. So that's when the kind of bells started going off. Maybe real estate's a good place to put our money, because if we can break even in a bad situation, what could we do in a more positive situation? So that's 2016 then came around. I had a new partner in real estate, which happened to be my new wife. I also started a new career because of our thoughts that real estate was going to be a good investment vehicle for us. Honestly, my new wife was also a nurse in the emergency department. She and I were both trying to save money in retirement and raising kids, and it was hard to stash away much savings, at the end of the year. And so I thought, I'll just get a real estate license, and maybe we can find some more properties like the single family house over there in Everett, and we can start investing in those and renting them out. And we did end up making a new investment. My wife had some money and I had some experience in managing a property now for a couple of years. And so we had an opportunity to buy 4 lots in Cedar Woolley, and they were duplex lots. They were what's called 0 lot lined, meaning you've got a duplex. It's got 2 doors, 2 garages, and 1 common wall. And the 0 lot line goes down that common wall to split it into 2 parcels, essentially. So it's got 2 tax parcels. They can be sold individually. That property was already under construction. At least the roads were in, utilities were in. They just hadn't started the building yet. And so we bought it at that semi-developed stage for $100,000. We had 4 lots, which was a great deal now, looking back on it. And then we got a construction loan. All of this stuff was new to me at the time. And the construction loan for that was $560,000. It was a good rate at the time, about 4%. And about 8 months later, we had 4 properties that we had to find tenants for. So I got renters in those, and they rented for $1,200 a month. They actually cash flowed a little bit because I was managing the properties. We didn't have to pay anybody, any property managers for that. So the big real estate lesson learned to me by 2016 was that patience and resilience pays. And by now, the house that was worth $185,000 in 2012 was now also back up to close to what we had paid for it, $275,000. We weren't in the hole anymore on that, and rents were up, and that one was starting cash flow too. So the big lessons with those duplexes that we bought was that understanding that appreciation times leverage, that to us is what equals financial freedom, because that kind of really exponentially transformed an investment of $100,000, which some of that money came from, we took a risk taking some of that money out of a retirement account and putting it into real estate. And currently this is a little snapshot of what that real estate is from. And I'm sorry, I'm not like sharing this stuff to be boastful or anything like that. I just think sometimes it's sometimes people talk about their journeys, but you're in the fog a little bit about what they've done because there's not a ton of transparency. I'm a very transparent person, so I'm just sharing
Oh,
this with
so
you.
this is awesome. Like you're more
Thank you.
transparent than I expected. So
Me too.
I love the story. I'm just like I'm glued. I'm like, so yeah, just keep going.
Okay. So, anyways, yeah, so we put that $100,000 into these duplexes in Cedar Woolley. And why Cedar Woolley at the time? It was cheap up there. And you can go do that now. You can still go to Skagit County and find relatively inexpensive land. I mean, obviously prices have gone everywhere, but now those properties, each individual unit is worth $390,000 according to Redfin, which actually in this case I think is pretty accurate. Even if it's 375, that's $1.5 million. And we owed initially that construction loan. I don't know if you remember, that construction loan was $560,000. So our $100,000 with a little bit of management effort over a period of 6-7 years is now worth about $1 million. I mean, obviously we'd have to pay, if we were to sell those, we would pay some capital gains taxes, and we talk about other tax strategies to avoid that. Obviously real estate fees and stuff like that, excise tax. But anyways, you can see that this is just one example, probably not even the best example of what somebody can do with their money in real estate. But that was $100,000 that now has provided a nest egg for us, which was our goal. So, and having accomplished that, you can see now we jumped from 2016 to 2021. That's 5 years. During those 5 years, we started to stash away some of that money from the rentals. We started to save a little bit more money. And in 2018, we found this property. It was advertised as a triplex. This is a picture from the MLS. When we found the property, it was marketed as a triplex property. And this is in Burlington. It was just dirt. So this was a little different than what we had, our experience in Cedar Woolley, where the property was already developed with utilities and everything. This was just ground up. And again, this is just one investment pathway. I don't think a lot of people necessarily get into development. A lot of people buy homes or apartments, multifamily, stuff like that. We just had that experience, so we said let's do it again. So we bought this land. In this case, the property was listed for $139,000. Actually, I think it was $145,000. We talked them down to $139,000, and we asked the seller to finance $39,000 of it. And we again took a little money out of a retirement account, and took some of that savings that we had from the few years of cash flow on rental properties and whatever we could stock away from our nursing income, and at this point now some real estate income too, because I became a realtor in 2016. I didn't get paid till 2017, but anyways, we had $100,000, bought this land, seller financed $39,000 over the period of time that we did architecture and civil engineering and stuff like that. We ended up paying off that seller, and this is what it looks like now. By fall of 2021, this was ready to be rented, and a few lessons, definitely. Like I said, we're new at this. I even I know I don't expect you guys to read this, but this was an email that was vital to this project and a lesson that we learned in this project. First of all, remember it was marketed as a triplex lot. We put 4 units on this lot, and I was able to confirm that with the city just by doing your diligence, going and talking to them. I actually like to go into the counter, talk to them face to face. You'll find some cities are more receptive than others, but you'll probably find that they're more receptive than you expect. People tend to want to help you, and most cities have like a growth management plan. And if you can find a way to provide a housing that fits within their growth management plan, they will be supportive of it as long as it meets, the code requirements and everything. So we did something called a tech review meeting. They call it a tech review meeting in Burlington. They call it other things in other cities. But if you did want to go down this kind of a path of real estate investing, it does take time. Like I said, we initially found this property in 2018. We tied it up in 2019, started with our feasibility, and then by 2021 it was completed. So it took almost 3 years. But then I guess if you go to the cities and talk to them, you can learn a lot. Don't be afraid to ask questions. So what this email is about is there's something called impervious surfaces. And when you have a lot, and this lot was 90 feet by 120 feet, and you could only cover like 50% of it under the current zoning when we purchased it. And we started to realize, wait, we need all these driveways. Literally, like after we closed on the deal, I started to think, oh my gosh, we've totally screwed ourselves because we can only cover 50% of the property. And this actually covers about 65% of the property. The thing was, though, it was mixed zoning. And so I just went and read the zoning rules. And this email that I have here in the corner is a note from Brad Johnson at City of Burlington saying, you know what, Adam, we agree with you. Because I bothered to ask the questions, and I did it in a way that says, like, look, we're new, we're trying to learn from this. This is like us paying our tuition in real estate investing. And it seems like because this is a mixed zone, that the multifamily zoning requirements could apply. And Brad responded with, yeah, we agree it can apply, and that does allow up to 70% surface area coverage. So anyways, I didn't mean to meander too far off of the path, but my point is, don't be afraid to ask questions, because you can, same thing with house hacking. If you buy a house, a lot of stuff going on right now is ADUs, auxiliary dwelling units. People in Mukilteo, if they have the space, they could add another apartment, a separate detached dwelling unit in their yard. And it's just an opportunity for you as investors, for your clients potentially, that you can go to and share a real estate investment expertise with your clients, that if they want to have additional income and they have an extra couple thousand square feet of space, they may be able to do that. And this is actually occurring not just in Mukilteo, but all over the place, where detached auxiliary dwelling units are being allowed and adopted into code. So anyways, that's one idea for folks. One more thing, another lesson. Like I said, we're learning. We learned that when we got that property done, we were going to have to do a construction loan. We had previously done on that Cedar Woolley property residential loans, like conventional loans. We knew how conventional loans worked, and we assumed that was going to be the same going into this project, that fourplex that we just talked about. But then I sadly learned otherwise. We didn't have to do any more. When we put that 100,000 in with the conventional loans, we got the construction loan. They actually kicked us back like $6,000 at the end of it. And so we thought we'll probably get a kickback for some of our investment in this fourplex property, because we were putting a lot of money down. We bought the land. We put like $80,000 into civil engineering and architecture and permits. You can see my numbers here. And we didn't get any of that money kicked back to us from the commercial lender, which we thought we would, because we were more than 70% loan to value. And we thought we could borrow up to 75% 5% of the property's value. And at the time it was completed, it was valued at about 1.6 million. So we thought, okay, great, we should be able to borrow about 1.2 million. And they said, no, actually, you need to have a debt service coverage ratio. That's what this DSCR stands for. And it has to be, I think it was like 1.3, I can't remember exactly, but the debt service coverage ratio is the ratio that a commercial bank requires for a property to loan against. And anyway, I'll take questions at the end. We can talk about what DSCR is, but it basically meant that we could only borrow $960,000. So all that money that we spent, some of it came from like HELOCs or from like a HELOC on our house and a lot of savings we weren't able to get back. However, there is a little bit of silver lining that we learned again, and this is where we learned about cost segregation. The following year, no joke, this is crazy, we were able to write off $274,000 from our taxes, from my income in 2022. So, and that was because, do you have a question, Joe? Oh, sorry. Because we're real estate professional. I'm a real estate professional, and this is something that builders do. It's called cost segregation. They essentially, when you normally depreciate a home over 27 and a half years, that's essentially what cost segregation does. But instead of doing it over 27 and a half years, they do this really complicated calculation, which, we did pay, I think, about $6,000, $7,000 to have this study done. But it essentially takes a lot of things like your roof, your furnaces, and evaluates the lifespan of those things and allows you to write those off up front. So in that way, we actually saved about $100,000. So that is kind of a kickback on some of those expenses. The other benefit in this case, we were fortunate that interest rates were relatively low. So we just refinanced our house, paid off that HELOC that we had borrowed money from. And then we had just a smaller loan. Instead of $1.2 million loan on this fourplex, we had a $960,000 loan. That means that basically one of those units from the rent on those properties, they rent for about $2,500 each. One of those goes in our pocket instead of to pay off that loan otherwise. So that kind of contributes to our financial freedom. Anyways, that's a lot of the story. There is a little bit more. We also bought an Airbnb and have managed that. I'm happy to talk about that. There's lots of different paths, like I said, to real estate investing. There's house hacking, I think, is probably the best one. I don't think the path that we went down is necessarily the best. It's definitely very expensive. I know sometimes, people don't have the opportunity to borrow against a HELOC. So I want to encourage people to explore other opportunities, and there's like burring is another great opportunity to buy a property, rehab it, put sweat equity into it, then rent it out, and then refinance it. And you can sometimes pull some of your money out of that. Like I said, we do have a short-term rental property, condos, just FYI. There's only 6 condo buildings in downtown Seattle that allow short-term rentals. But condos in downtown Seattle right now are, for a city, like a metropolitan area, as beautiful as Seattle. Downtown condos are really cheap right now. So if you can find one in one of those buildings, I'm happy to share what buildings those are. There could be an opportunity there to do a short-term rental. Ours generated $72,000 in gross revenue last year. And we're cash flowing about $1,500 a month on that. Multifamily is another avenue that you could go and invest in. I know this isn't necessarily easy. We're not all like totally loaded, but you might have a friend or a client or a partner that you can join forces with. You can even meet investors in groups and start to do some of the legwork. I've also done that. I do have some investors and developers that I've worked with to help them find land. I'll present those, and I've sat down with them in their offices to talk about what they're looking for. And again, they kind of look at these growth management plans for different cities and see where they can fit their product in, whether it's multifamily or, luxury single family homes. A lot of times they're looking for advantages like being able to buy a parcel and being able to split it up, or being able to convert a single family zoned home into something multifamily, or and a lot of times you can go look at the maps to see where sewer lines are. Sometimes that can make a difference. Understanding what parking requirements are for different zones, and if parking is going to be an issue for the builder. Those are all things that you can learn by sitting down with builders. You can just call builders on the phone, go introduce yourself at a job site. Commercial and mixed is another pathway, single family homes, and like I said, partnerships and LLCs. We did buy, I think I mentioned earlier, we have 4 vacant parcels now in Burlington that we can fit 18 townhomes on. In that case, we were pretty strapped at the time that opportunity came to us. We didn't have any money to put down on it, and it was $600,000. I called up a good friend, obviously a very good friend, and he agreed to partner with us. So we bought that for 600 grand. We've since paid off our half of that with him. Some of that again came from a HELOC, but now we have another opportunity potentially going forward to continue kind of this journey that we've been on. So what's your real estate investment journey, you guys? These are just a few things that I think are important. Educate yourself. Again, don't hesitate to ask questions of builders, city managers, me, your mentors. We found listening to Bigger Pockets podcasts while we were running on trails and stuff like that is like really valuable. That's a podcast that probably a lot of you have heard of now. We started listening to it back in like 2018. And anyways, it's just got a plethora, like, I don't know, I think they've done at least over 1,000 episodes, tons of valuable information in there. Read or listen to investment books, partner with an investor, and use your license. Like, get out there. I know there's not a ton on the MLS right now, but you don't have to search on the MLS. Remember, there's canceled properties, there's expired properties. Those sometimes are opportunities for investment. And don't be afraid to take risks. You gotta take some risks. It's a little scary, but if you can take a calculated risk, go for it. And if you have opportunities to do HELOCs, HELoans, seller financing, all that stuff can be explored. And I guess the last piece I have here is just a little food for thought. Like, what is that little house that we considered short selling worth now? It's worth about $525,000. And we actually are considering selling it to pursue that townhome project. And when I think about it, I think, gosh, do we really want to do that? And I honestly don't know. Like, I'm still kind of kicking it around. But so I just thought, what would happen if we just held on to this house for 10 more years? It's already cash flowing. It's really easy to manage. 10 years, I'll probably have 5, 6 tenants that I have to, show around, and maybe I'll have vacancy over the next 10 years for, I don't know, 10 weeks, maybe a little bit more than that. I'm usually able to turn them around pretty quickly. And over 10 years, this thing at 4% a year will appreciate another $255,000. That's pretty passive. It'll cash flow $100,000 over 10 years. And the tenants in this house will pay down the loan on it by $50,000 over the next 10 years. So, I mean, that's $305,000 that over 10 years, that's pretty good for passively building your wealth. So that's only 10 years. Imagine if we held on to it for 20 more years. I hope that I'm still alive then. But that'd be a pretty awesome nest egg for one of my kids. So anyways, that's I think that's all I got right now. I'd love to hear questions if anybody has anything, and you guys can take it away now.